Earnings expectations.
Yeah.
The uphill battle here.
Okay, that's, I think, the backdrop here is that stocks at highs. There are some forces here that I think generally have been positive for the equity market. The big one here is the earnings that have surged. But let's jump into the terminal real quick, because this tells us a story here that is kind of good and at the same time perhaps somewhat worrisome. I don't know if I go that far, but if we jump in, #BTV 4094 on the terminal. The turquoise line here on top is the forward 12-month earnings per share. That's what's expected by the S&P 500. $130 earnings per share in the next 12 months. Y line is trailing 12 months, 113. Now, both of those are at the highs, really taking it back more than a decade. That's great news. That means we're doing well. Bottom panel here, what's interesting is you're actually looking at the spread between the two. That's where it gets a bit concerning in terms of the biggest gap between the past earnings and the forward earnings back to 2008. That means that we've got a lot that we have to get through. So even though we're going to see a lot of green on the screen for earnings over the next couple of weeks here, you have to keep in mind the expectations are high.
Expectations are high, but not for everything.
Not for everything.
Banks, for example, expectations have been coming down, and banks are beating those expectations wildly. If you just take a look at Goldman Sachs, for example, and do EEG,
love EEG.
Look at this. If you wouldn't mind jumping into the Bloomberg, you can see that the red line is the expectations from analysts, and it's way down in the trough, whereas the actually happening is the white line. That's
a great chart. I'm actually glad you brought that up. I think it's better than the chart that I had. So let's go with that. This is Goldman's earnings revisions here. I was actually just talking with Charles Peabody yesterday for a story that's on the terminal today from Compass Point. And this is actually exactly what he brought up when I said, show me one chart that you're looking at for financials. He brought up Goldman Sachs EEG, the earnings estimate. That turn down there, I think, is a big reflection of expectations that have to come to play post-election. Because if you look at the gains for the financial market, 25% since the election. About 75% of the gains we've had in that index were actually just in the couple of weeks before the end of the year in 2016. What that means is that investors got really excited about a lot of promises, but then we have to wait, and then the earnings start to get ratcheted down a little bit, and then you have to think about the spread between the bond curve and how that is tightened. There's a lot of things here that have not worked in the favor of banks, and I think that's why some of those estimates have come down. However, at the end of the day, the long term, the year-long estimate for banks is still very good, 18% growth this year. It's just that it's getting pushed out to the fourth quarter. The second and third quarter expectations are what have been ratcheted down.